there's also a reduction of the income tax basis of the property, so you're getting 85% of those depreciation deductions. One of the, well, I'll go through some major differences between the investment tax credit and the cash grant. First, with the cash grant, you could sell, again, you could sell the property to an eligible person without having to have any recapture, as long as this agreement's in place that buyer will be jointly responsible for any recapture. Two, you can sell, this is key, you can sell an interest in the ownership entity to an eligible person and also not have a recapture event with the cash grant. One of the advantages of the investment tax credit is if you do have an ineligible participant as an owner of the entity that's going to be owning the property. So let me give you an example. A pass-through entity such as an LLC does not pay tax. An LLC just allocates the tax attributes to its members. So you might have a situation where a private equity firm is the owner or a part owner of your LLC, and a lot of private equity firms have tax-exempt pension funds as owners. So if you've got, under the investment tax credit, if you've got, when you look through the entire structure, if you've got a tax-exempt entity owning 5% of the, effectively, of the property, then under the investment tax credit, you're only going to have a proportionate denial of that credit. So instead of getting your $3 million, you're going to get 95% of your $3 million of tax credit. With the cash grant, it's a complete denial. So that's one of the big differences. Other items to consider, tax issues. Rec payments that you get are subject to tax. One of the issues is whether the cash grant is subject to tax for state or local purposes. Let me go back. The cash grant, from a federal standpoint, is not subject to taxation. So it's a non-taxable cash grant. We don't know at a state or local level. Most folks here in Arizona say that it's not taxable. There's an issue in California. Let me skip through. So let me talk about the different structures you see. From a big picture, from a 30,000 feet perspective, you either have a go-it-alone model where you get the cash grant and you finance your own project, or you go out and you seek a third-party equity investor and you monetize your tax benefits. The issue with the go-it-alone model, again, is can you take advantage of these losses? Because these losses are going to be subject to passive loss rules and at-risk rules unless you are a widely held C corporation. So from a monetization of tax benefits, going on and getting a third-party equity investor, there are three different models. First is the partnership flip structure. And this is a situation where the equity investor, I'm going to throw out a transaction where we need $10 million. So on a $10 million deal, the equity investor is going to get a $3 million cash grant. They're going to get depreciation benefits on $8.5 million. And when you present value those benefits, it will come out to somewhere around $1.7 million. And then they're going to get cash flow. So those are the three different sources of their internal rate of return. So on a situation where you know that you're going to get about $4.7 million of tax benefits, an investor would likely give, let's say, $4.2 million. So if $10 million of the $10 million that you need, you're going to get 4.2 from the equity investor. You're going to go seek a third-party loan. Maybe that's a loan to value of about 50%. That would be another $5 million. And right there you got your 9.7, and then you're going to need $300,000 of your own money as project developer. And so the way the partnership flip structure works is the equity investor is going to get 99% of all taxable income for the first 5 years, and then it's going to flip, the economics are going to flip so that the project developer after 5 years is going to end up with 95%, and the equity investor is going to have 5%. So this is a model that was employed in the wind industry years ago, and then the wind industry went to the IRS and sought a private letter ruling. IRS didn't give them a private letter ruling, but then issued something called a revenue procedure, which is a safe harbor that says basically if you do the following 10 items and you ask us for a private letter ruling, we'll give you a favorable one. And so the way these deals work is, again, at the end of 5 years, which is the tax credit recapture period, the taxable income and economics will flip so that we're 95% for the project developer and 5% for the equity investor. And then the project developer will have a call option to buy out the equity investor in the revenue procedure that's applicable here. We'll say that it has to be at least fair market value for what a 5% interest is. So, I know I'm flying through this. Oops. Did I get this? I'm going to talk about the sale. Do I have a few minutes? Okay. Well, I'm just going to talk about the sale leaseback. And all these slides are in your materials. I'm going to avoid talking about the third model. But sale leaseback, lessee sells the equipment to the investor. Investor leases back the equipment to the project developer. The investor is going to end up with the credits and the depreciation. Investor is going to go seek its own financing, debt financing. This is another structure that's commonly employed. Investors like this structure. Investors like this structure because under the tax rules with the sale leaseback, the sale by the investor of the solar equipment could occur 90 days after place in service date. So what this does for the investors is it avoids them having to take on construction risk, and because there is a set rental stream, the investor also doesn't have to take on operational risk as they do with the partnership flip structure. So again, these are two of the three structures. Third structure that we see is something called the lease pass-through. And the thing to take on the lease pass-through is that this is a way for the investor to take the credits but not have to take the depreciation deductions. So the depreciation deductions will stay with the developer. And so a lot of investors will employ this because the losses from the solar equipment will actually hurt their financials from a GAAP accounting standpoint, and so they don't want the losses, but they do want the credit. So this is a common structure to be able to separate those two. That's it.
Yeah, thank you very much. I'm sure you learned even more than I did. This is the first time I've seen this in this detail.